You studied the patterns. Doji, hammer, engulfing, pin bar, morning star, evening star. You know them all. So why are you still losing money? I am going to answer that question in the next 10 minutes. And the answer is going to surprise you, because it has nothing to do with needing more patterns. It has everything to do with what happens inside your head the moment you see one.
Candlestick patterns are tools, powerful tools. But a tool in the wrong hands produces the wrong result every single time. The same hammer can build a house or break a window. The same candlestick pattern can make money for one trader and lose money for another on the exact same candle. The difference is never the pattern. The difference is always the psychology of the trader reading it. Psychological error number 1. Fear distorts your entry. A perfect hammer forms. Textbook reversal signal. Your plan says enter here, but fear says, what if it is a fake signal? What if the market drops more? Let me wait for confirmation. So you wait. The candle moves without you. You enter late, chasing the move at exactly the wrong price. And you get stopped out. Not because the pattern failed, because fear made you enter late. The pattern was right. Your psychology was not. Psychological error number 2. Greed makes you ignore your stop loss and your target. You enter a perfect bullish engulfing pattern. The trade moves in your direction. Your planned target is hit. But greed says, this is going higher. Let it run. So you hold. The market reverses. Your profit disappears. You hold more. It drops further. Now you are at break even, then negative. And what was a winning trade becomes a losing trade. Not because the pattern failed, because greed moved your goalposts after the game had already started. Psychological error number 3. Ego holds your losing patterns long past logic. You see a perfect pin bar. You enter. The market immediately moves against you. But ego says, this pattern is valid. My analysis is correct. The market will turn. So you move your stop loss just a little further, just to give it room. And a planned 1% loss becomes 3%, then 5%, then 8%. Ego turned a controlled loss into a catastrophic one. The pattern was unclear, but ego made you certain. And certainty in an uncertain market is the most expensive feeling a trader can have. So here is what this means in practice. 2 traders, same chart, same candlestick pattern, same market. Trader 1, driven by emotion. Fear makes him enter late. Greed makes him ignore the target. Ego makes him hold the loser. Result? Losing trade. Trader 2, driven by a system. He sees the pattern. He checks his 3 rules. He enters at the right price. He takes profit at his target. He exits at his stop if wrong. Result? Winning trade. Same pattern. Same candle. The only difference was the psychology of the trader holding the mouse. Let me show you 2 real traders. Same Forex pair, same session, same hammer pattern. Mark
Emotional trader. Mark sees the hammer form. He knows this pattern. But fear says, wait for more confirmation. He waits. The candle moves 30 pips without him. He chases the entry, 30 pips late. Gets stopped out immediately. Blames the pattern. Sarah? System trader. Sarah sees the exact same hammer. She checks her 3 rules. Pattern at key support level? Check. Stop loss below the hammer low? Placed immediately. Risk to reward at least 1 to 2? Confirmed. She enters at the close of the hammer candle. Trade moves in her direction. She exits at her planned target. So, how do you add psychology to your pattern trading? 3-step pre-trade checklist. Before every candlestick pattern trade, you answer 3 questions. Question 1. Is this pattern at a key level? Support, resistance, moving average? If yes, continue. If no, do not trade. Question 2. Is my stop loss placed before I enter? Below the hammer low? Above the shooting star high? If yes, continue. If no, do not trade. Question 3. Is my risk to reward at least 1 to 2? If my stop is 20 pips, is my target at least 40 pips? If yes, enter. If no, do not trade. These 3 questions eliminate fear from the entry, eliminate greed from the exit, and eliminate ego from the stop loss. The pattern becomes mechanical. The psychology becomes irrelevant. Candlestick patterns are not the problem. They never were. A hammer at a key support level, with a stop below the low, and a 1 to 2 risk-reward target, is a valid trading signal. Every time. The problem is the trader reading it through fear, or holding it through greed, or ignoring the stop because of ego. Fix the psychology, and the patterns start working. Not because the market changed, because you did. Drop a comment below. Which psychological error do you make most often? Fear at entry? Greed at the target? Or ego at the stop loss? I read every single comment. And if this changed something for you, hit subscribe and the bell icon so you never miss a video like this. I put out content exactly like this every single week. I will see you in the next one.